this computer. Okay, so yeah, just for the recording, a recap. The bond is where we'd see the lowest risk. It's considered the lowest risk. Primary market fixed income products would be the next level. So this low to moderate. Secondary would be moderate to moderate aggressive. Defensive equities or equity exposure would be considered at around moderate, or depending on the equities, whatever they are, would be moderate to aggressive. And commodities would be considered more aggressive. Okay. So this is what you're looking at. What you're looking at here is the total investment amount, the issuer, like the bank or the company that's providing the product, the category of what kind of asset it is, what assets are in that product, the annual income you can expect in this column, the dividend payment, and that's based on the amount invested times the return divided by the frequency. And that means that semi-annually, this would be 625 if you had 10,000. Obviously, if we went in here and put in, I'm sorry. Oh dear. Yeah. Okay. So if we went in here and said, no, you know what? I want to increase the exposure here to 20,000, automatically we see it reflects. Okay. So I'm just basically giving you a walkthrough so you know what you're looking at when you look at this later. So down at the bottom here, we summarize based on the recommended allocation, which is 10,000 in each. That would generate an income annually of 2,850, which would create over that 20,000 a total return of 14.25%, and it represents an exposure of 16.67% of the portfolio in these assets. Okay. Okay. Here we have some links. So if you said, well, what is this thing? What is this bond? We click on the link, and then it opens up the information about what that investment is, who the people are behind it, all the facts that you need to know about that investment, okay, which we'll come to in a moment. Okay, so I just wanted to show you, give you a guide through so you can see what does all this mean. What I should do is lock these boxes. Freeze header rows. There we go. So then as we come down, you can see that what that refers to. Okay. On the bottom side here, we've got the total investment amount, the total return, combining expected capital gain and expected dividend income. What that represents as a percentage of the overall investment amount, the income from any of the products that are paying income monthly, quarterly, semi-annually, and that is put down here. So the total expected annual cash flow of this portfolio would, on 120,000, would be 18,000. So the income side of it would be generating 15% a year. The monthly cash flow would be 1,188, the quarterly 707, and the semi 625. In terms of asset allocation, this is what you're allocating to, which is reflecting down here in terms of asset allocation. And this table here is assuming compounded growth of that yield every single year, which isn't a guarantee. It can be up and down, but like I say, we've got plenty of room to ensure we get good results with this. So that's basically what we're looking at as the investment proposal. Okay. What I want to do now is to talk to you a little bit about the assets that I'm recommending and why I think they're good assets for you to consider. Okay. So let's go one by one. CSM bond, what is this? CSM are a consumer loan purchaser. What does that mean? In the US, and many, like most places, even in Mexico and Brazil and many different countries, the banks will lend money out and then they will have people that don't pay them back, and they default on their mortgage and they default on their loan. If someone with a credit card doesn't pay back their credit card bill after 6 months, automatically the bank writes that off and says, that's a loss. I have to get this off my balance sheet and write that off as a loss. So what they do is they sell that book of business to credit collectors. And the credit collector will say, okay, how much have you got in bad debt? Oh, we've got 20 million. And then they bid for it. And they'll say, okay, I'll buy that book of debt off you for 2 million or 3 million. Normally they'll pay around 5% of the total value of all that debt, because they know some of it is dead, but they also know if they invest time and money chasing people, that they can recover some of that debt. So these guys in the market have been doing this for many, many years. And basically what they do for you, if you're investing in their product, they will pay you 12.5% per year over a period of 5 years. If you want to have a short-term bond of 18 months, they'll give you 8% a year, which is 12% paid over 18 months. So you put your money in, you get your income semi-annually or annually, and then you get all your money back at the end of the maturity. What are they doing with your money? They're using that money to go and buy that debt from the bank, and you are the first creditor in line. That means as soon as they start recovering debt, they have to make sure that before they take any profits, that their bondholders get their payment back. And then once they raise that 8 or 12%, then anything over that, they take profit for themselves. Okay, and that's the business model. You're creating the finance that can buy the debt for that business so that then they can pay you back and then they make profit over it. Typically, they recover around 30 to 40%. So they buy a book of debt that is worth 20 million for 3 or 4 million, and then they'll recover around 8-9 million. So they pay you back, they give you the interest, and they make a very good profit for themselves. So this is US registered, US listed. The good thing about debt in the US, it's extremely transparent, and there's also a massive incentive for people in the US to pay back their debts. Okay, why? Because everything, if you need to get a job, if you want to rent a house, if you want anything, everything depends on your FICO credit score. If your FICO credit score goes too low, then it can lock you out of many basic services and things like this. So let's just come through here. So this is what it looks like. This is one of the examples. They purchased a book of $20 million worth of debt for a cost of $1 million. And they recovered $3 million. Okay, so they made 3 times the return on the capital outlay, but they only have to pay 12.5% back to investors. So why would someone want to do this? Well, this is what they do, is they buy that book of debt and they call you up and say, listen, Mr. Smith, you borrowed $1,000, which you owe to the bank. Now, because you defaulted on your debt, your FICO score is at 650. And that's going to stop you from borrowing money. It's going to stop you from getting credit or getting a rental or whatever you need to get. So what we want to do is help you to improve your credit score. What we're going to offer you is to pay back not the $1,000, only $700. And what we can do is create a payment system where you pay $50 a month, every month, for the next 14 months. And in exchange for that, we will upgrade your credit score from 650 to 710, which would put you back towards, the very good side where you can actually be a functioning person in the US again. And so this is a model that's been around for many, many years, but it's a problem in Brazil and Latin America because those markets are too messy, and it's people don't really care. If they've got bad credit, they've got bad credit. But in the US, they depend on it. So because of the transparency and everything of the system, it's very, very nice in order to have exposure to this kind of strategy. And with what's going on in the world now, there's more and more people defaulting on their debts, which means that these companies, the banks are getting so much more bad debts that they need to offload it. So it means that these companies can actually bargain a much better purchase price of the bad debt to go after. So this is how it all functions from the investor, from the issuer. It's all fully regulated in the US. They're buying books of business off the big US banks, and they've been doing this for many, many years very successfully. So that's what that is. I like it as an alternative fixed income. The next one that we have is Pegasus fixed income. This is, again, is an alternative fixed income. Okay, let me just pick this up. I'm going to have to update the information here. But essentially what this business does is they are traders that trade currencies. So the dollar pound, the euro pound, the Mexican peso, the dollar. The good thing about currencies is that, they never disappear. The prices fluctuate, but they never go anywhere. Good traders that trade currencies implement a very strong, strict risk management. What they want to do is just make a little bit every single day and not be taking too much risks. It's widely known that 70% of traders who trade currencies lose money. Only 30% actually make money. And they're the professional traders. The professional traders only want to work with the big investment funds because the more money they're trading, the more money they make for themselves. So Icarus has been around again for many years. They trade over $100 million a day in currencies, and that attracts some of the best traders in the market. When they trade, there's two sides of currency trading. And normally, if someone talks to you about FX, it's high risk because you put your money on, the trader is trading in the market, you're taking the risk of trading. If the trader makes money, he makes money. But if he loses money, you lose money, but he still makes money from commission. So what these guys did is said, well, you know what? Our business model is successful. Our trading results are good. Their trading results, 18%, 19%. This year, they ended up at 21% at the end of the year. So their results are good in trading because they're more conservative. However, this isn't risk. This isn't you trading the markets. What they said was, if we were to combine the performance from our trading strategy with the commissions that we make, we could guarantee a consistent fixed income. So what this fund does, it actually pays out 16% a year, which is 1.33% a month, every single month, regardless of what happens on trading. Why? Because they combine the trading, which is the blue line, which you can see the volatility here from a monthly basis in terms of performance, and they combine that with the orange line, which is their commissions. So if you can see here, let's take some negative months. Here, they lost 2% in performance, but they made 2% in commission. Here, they lost 1% in performance, but they made 3% in commission. So when they have a positive, they're making money on commission and on money on trading. And when they have a negative, they offset that volatility with the commissions. So by doing that, the net result of performance here, 47%, 40%. So if they pay out 16% for you to be financing for them to be able to trade in the market, then they're actually making more money by having access to this financing, which is similar to you financing the debt purchase. Here, you're financing the trading, and they're giving you a return. Daily liquidity. The other thing that's interesting about this strategy is they provide you with a certain guarantee. So here is the fund itself, Icarus Investment Strategy. And this is how I can explain it in the best way. So they did a simulation in the very worst case scenario. This is 2020 trading results. And you can see their trading results gave 18.23. They took a performance fee for their business of 6.7. They took administration fees of 2%. They generated commissions of 29%. They paid out the 16% dividend to investors at 1.33% every month. And this is the value of your account, 100, 100, 100, 100 the whole time, one par value. But their account is not par value. Why? So how do they manage this? They put in a reserve. So if someone invests $100,000, they deposit $20,000. If trading is going positively, then you would be able to take that profit, and they don't want that to happen. So in a month where they have positive trading, they take that positive 0.8% and they deposit it into the capital reserve account to build the protection account. In negative trading here, where they lost, they take that money from the reserve account and put it back. So regardless of positivity or negativity in trading, your account constantly stays at 100 because they have that buffer to soften out the volatility. So your money is always at 100. You come in today, you want to get out tomorrow, you get exactly the same money back. And what you'll be receiving is 1.33% a month. So they run a simulation here in the worst case scenario. Let's imagine if they lost money every single month and lost money aggressively, they only made money, for example, in 3 months of the year, 3%, 4%, and 3%. And for 9 months of the year, they lost quite big. In that scenario, in a positive month, they'll take a performance fee, an admin fee, generate commissions, pay out the dividend, and that's the result. But in the negative scenarios, they're losing money, they're compensating a little bit from commissions, but they're still having to take an admin fee, still have to pay the dividend, And what happens? That buffer goes from 23, it compensates that 97. The buffer drops down, you still get 100. Here, 96, they take money from the buffer goes down, but you still have your 100. They make a positive return, they bump up their buffer. So this way, you're basically getting fixed income from something that's not related to debt or stocks. It's a completely different asset class to give us diversification of asset exposure, but it's paying you 1.33% every month. Okay. I know this is a lot of information, but it's being recorded, so you can go back and look at it slowly and make notes and ask any questions if you want to. So the next stuff is what I showed you in the last meeting. This is where we take good quality stocks that have lost value, they're not trading at their high values, and then we put an even bigger buffer of protection underneath them, and then what we get is an income rather than trying to get stock performance. So for this, I'm going to take you to our platform. And I'm going to show you what I'm recommending. So one of the assets, the first one on the list, is this. So this is a product that tracks Meta, which is Facebook, Unity Software, which is one of the biggest gaming and software producers, and Roblox Corporation, which is a huge gaming thing for kids. If you know any young kids, then you'll always see them playing around on this thing. Anyway, basically the focus of this is the metaverse, but we don't depend on the metaverse. These businesses are completely independent without the metaverse. So if the metaverse does take off, they're going to do well, but they don't need that to happen for them to be profitable. They're all trading at good discounts right now. So look, if we look here, we see that analysts on Wall Street have a target price of at least 154 for Facebook. They have a target price for Unity Software of 37, and they have Roblox has a target price of 38. This was the price when we launched the product. This is the current price of the stocks, and this is the protection, how much the stocks can go down and you still won't be affected. So the protection is 40% lower than these initial prices. Since then, Roblox has gone up by 30%. So in order for Roblox to be underneath the protection barrier, it would have to lose 30% and then lose another 40% before you're at any kind of risk. The others are basically where they were when we started. This is paying out an income of 25% a year, and that is paying out income of 2.1% a month every single month. If we go into a major crisis and the stocks go down below the barrier, nothing happens. You just don't get your dividend. And that happened actually in November last year. There's a lot of volatility, a lot of panic in the market, and Facebook dropped quite a lot, went down negative 39.5%. We missed a dividend, but the product has a dividend memory feature. So when the stocks come back up, it will pay out any dividends that have been missed. And this is really important because we are currently in a recession. Whether people say we are or not, we are in a recessionary market. Recessions typically last around 2 years. So when we have a maturity that goes to 2027, giving us, 5 years, 4 years, 5 years from today, then we expect that even if we go into a really bad scenario, that the market will recover and come back. So that's a natural part of market cycles. Inflation goes up, interest rates go up, market stagnates, demand goes down, inflation comes down, interest rates go down, and then we go back into the next growth cycle. So the problem is, if you buy stocks today, there's a good chance that you might have to wait 2 or 3 years before you get back to zero, and then you're still losing money to inflation. This way, we can buy good quality stocks. Even if they go down, we're getting income. And over the next 4 years, we only need them to perform negative 40% to be making 25% a year. So it's a much better risk reward. It's a lot more protected and lot easier way to, one, generate good income, and two, to make money even if the market is flat or negative. But we expect in 4 years we'll be back into a good market. But if we're not, we've got all that room of protection. Okay, so this is one of them, which is based on, technology shares. We have another one, which is primary banking. This one pays 22%. How this one works is the following. It tracks Commerzbank, ING, Barclays, and Goldman Sachs. The banks are in a very good position at the moment. They're very undervalued. When interest rates are high, they make more profit on their margins. So that's why we see them as being actually, if you wanted to buy stocks today, some of the best stocks you can buy in the market are banking stocks. And I'll show you why. I'll show you why the banking stocks are interesting. Let's take, for example, Santander in Europe. I don't know, I'll pick the German one, but should maybe pick the Spanish one. So look, so the reason Santander is an interesting investment opportunity is because the price to earnings ratio of a bank today is around 10. The price to earnings ratio of Microsoft is 35. The price to earnings ratio of Amazon is like 100. The long-term average price earnings of the stock market is 14. So when we compare where some companies are show up here and others are down here, in this market, what you want to own is companies that are cash rich, because then they're not having a problem with the pressure of rising interest rates, increasing their debt costs. So by having a price earnings of 10 and having a positive free cash flow of $2.5 billion, they are stable and they're cheap. They're undervalued. So that's why we like banks. I mean, I could spend more time explaining, but I don't want to waste your time. I know we're talking about a lot of stuff here. So that's why we like banks and we like financials. So here, what do you get? We would get a basket of Goldman Sachs, Barclays, ING, and Commerce, some of the biggest banks in the world. And you would have a capital protection of 50%. Even if they lost 50% of their value from today, you would still get all of your money back. And you'll be getting accumulating an income of 21% a year, which is paid at 5.25% per quarter. It's a very strong income. One thing I have to say, when I talk about these numbers, 25%, 22%, people are like, how is that even possible? Now, the reason why it's possible, two reasons. First of all, when we create a structured investment, the yield that we can get is dependent on market volatility. If the market has been very volatile, then the yield that you get paid is a lot higher. And right now we're in a high time of volatility, and that's why yields are higher. But if you were being offered this product, if you went to a bank in Mexico and said, I'd like a product like this, the product will be issued by a bank like BBVA, but then a bank in Mexico will then want to distribute that. That bank wants to take commission for distribution. The finance director, the sales manager, everyone's getting paid. The bank manager himself that's promoting it wants to get paid a commission. And when you build all of that in, these yields go from 20 down to 10, down to 9, down to 8. So that was one thing that we pioneered in this market, was to be able to go to the institutional level and cut out all of those tiers of distribution. So when I go and look in the market, I'm looking at getting it at the same price the banks would get it before they put it into all the distribution. So if I show you an example of this, of how we operate. So this is an example of a product that we priced not so long ago. Okay, come on. Why is it so slow? Okay, I clicked the wrong thing, that's why. So here is an example. So here, we priced up a product based on Tesla, Facebook, and Apple. Now, you can see here that Societe Generale is offering 20%, Morgan Stanley 22%, Credit Suisse 23%. So that is the institutional price. When that then goes to a bank and whatever, then you start building in the commissions, that's when it all drops down and drops down. So by going at that level, then we can give you institutional pricing. And then also what we do is we check all the banks in the market. You know, Societe Generale is paying 20, but BBVA is paying 23. The risk of the product is the same, but we're getting an increase in yield of an extra 15% just by basically comparing all the banks rather than just sticking with one bank. Okay, so that's what we're all about, efficiency to deliver the maximum returns for investors. So this one's paying 22. We have this one, which is paying 12%, which is a bit more normal. These ones They're rare, but they come up every now and then with big yields. But this is the normal that you'd expect, 12 to 15%. If we look at this one, Alcoa, I really like this one. So this one is Glencore, Rio Tinto, Alcoa, US Steel, ArcelorMittal, some of the biggest industrial metal and mining companies in the world. Okay. Real assets are extremely important when you have inflation. Currencies devalue, everything devalues, but the real assets actually increase with the value and protect you from inflation. If we look at the companies, are they safe and are they expensive? United States Steel, for example, is a stock I would happily buy. I just don't think the stock market's going to perform for a year or two. So look, price earnings of 3 times, only 3 times. That's super cheap. Their book value. So if United States Steel sold all of their assets, you would get a book value of 1. But you're buying from the current price of today's share price, we're paying 66 cents per dollar of assets that they own, which is fantastic. They have a 1.7 billion positive free cash flow. They don't need any debt. They have 19 billion in assets and only 4 billion in debt. So they're financially secure. They're trading at a price which is way below the fair value of their assets. And their price to earnings, you're buying them for a multiple of 3 years earnings. Normally in the market, you pay 15 times the earnings. So this is a good stock. Why am I telling you to buy it? Because I just don't think the stock market is going to perform for 2 years in this crappy inflation that we have and all the problems that we have. So that's why I'd rather take those stocks, put them into this, give ourselves a protection that even if they lost 40% of their value, you'd still be protected up until basically 2028. And in the time where we're waiting to see what happens in the markets, you're going to get paid 1% a month every single month. And you've got the liquidity to sell it and take all your money back if anything changes or you want to do anything before. You're not locked in for this maturity. You can get out whenever you want to. Okay. So we have a few more. We have digital payments paying 19%, China recovery paying 18%. And all of these, you say, Charles, I don't like China. Charles, I don't like tech. Can you show me some alternatives? Gold mining. Can you show me whatever, even Apple, Amazon, Google, whatever you like, we can design or we can find and make it really fit your needs. If you say, you know what, 25% is great, but I don't need that, then we can build in even more protection around the structure, which buying protection will reduce, but that could drop 25 to 20 to 15 and be even more bulletproof. So we can pretty much tailor-made anything you need. So in this part of the portfolio, I'm recommending an allocation of 60,000. The total return of that would generate a 17% return on that part of the portfolio. And that's going to be a total exposure of 50% of the investment amount. Secondary market products, what are they? A secondary market product is one of these products, but the stocks have come down in value. And so we can buy it at an even cheaper price. Okay, the trade-off is that you're closer to the protection level. So let me give you an example here. Airbnb. So in this product, why do we like this product? Well, first of all, in a recession, people still want to go on holiday, but they might not go on an international holiday. They might just go locally. If you go locally, you still use TripAdvisor, you still use Airbnb, you still use Booking.com. You might not be getting on a plane, you might not be using a Marriott hotel, but you still want to, spend time with your family and have a holiday. So digital platforms for tourism are actually in a much better place than the Marriott hotel or some of these resort chains and stuff like this. So that's why we like them as a concept in this market. In this product, it started in 2021. It has a maturity at the end of 2024. But because of what's happened in the markets, TripAdvisor is currently trading at a 38% discount from its initial price. The market has an expectation, target price of pretty much where it is, around 24. Expedia has an expectation to be at 129. It's currently at 114. So all of these are above their protection barrier levels. But the price of the product today is 71. So that means that, let's just get the calculator out. Okay. Nice to be on the same page. Here we go. So what does that mean? A market price of 71. It means if you wanted to buy $10,000 worth of that product, you only have to pay 7,178. Okay. So that means that this product every year pays $9,380 divided by $71,780. So it means that instead of you getting a 9% dividend, because you're buying at a discount, your dividend increases to 13%. Okay. And at maturity, you get back 100. So that is what? That is 29 divided by the 71 you invested. So here, what you're getting is a 13% dividend. And if the product matures above the barrier levels by 2024, you'd also make a 40% capital gain on that product. The trade-off is you're coming in and you're on the barrier. If the stocks end up below the barrier, then the market price would go down to like 60 or 50. And then at maturity, you'd say, okay, well, I made a loss because they ended up below the barrier. So that's the trade-off, right? So if you're in a primary market product, you've got all that room of protection and you're just going to get the dividend it pays. If it's already existing in the market, the more it drops down in value, the more capital gain you can make and the bigger the dividend, but the closer to the protection barrier. So you've just got to say to yourself, do I think that these stocks will be where they are today or better by the time we get to maturity? And if that's the case, then it's a good investment. If not, then probably not an investment you want to make. Okay. So we have that on that one, and we have that on this one here. So we have the tourism platforms, where you might like it, you might not. This one I love. Okay, and I'll tell you why. This is for me a fantastic risk return opportunity. NEO. Now, when it comes down to it, I'm not going into specific details about each one of the stocks and why they're good, because it would take too much time. What I want first from you is, if you like it, to say, Charles, yeah, I do like it. I like this. I don't like this. Can you give me more explanations about why this would be a good investment or not? And then we can go into more details there, just so you feel comfortable about the why behind what we're doing. So this product here is really interesting. It tracks NEO, which is the largest electric vehicle manufacturer in China. They're one of the best as well in terms of the quality of the cars that they produce, and they're rapidly expanding in Europe. We've got Ford, which is going heavily into electric vehicles, and Tesla. So we launched this product in 2022. It was paying 14.65%. Since then, Tesla has gone up 174%. So Tesla would have to drop 174 and then another 45. So you pretty much don't have too much risk of Tesla. Ford is doing well as well, but NEO is down by 50%. And it's slightly under the barrier. Why? Well, in China, they had a technology crackdown. Then there was a threat they were going to take Chinese stocks off American exchanges. Then they had the COVID lockdown. Then they had a huge real estate corporation called, forget the name now. It's on the tip of my tongue. But anyway, their biggest real estate developer was threatening to go into default. Then we had something else happen. What was it? There's so many different things going on in China. Anyway, we basically had 5 things, one after another, happening, which pushed Chinese stocks down and down and down and down. But really, that affects real estate, that affects banks, that affects tech. It doesn't affect the biggest electric vehicle car manufacturer. So what happens is investors just pull everything out of China indiscriminately. They don't say, oh, that's good, that's bad. It's like, oh, the US is bad, I'll sell the whole of the NASDAQ. Well, Amazon and Google could be doing great, but I'm selling them anyway because they're in that basket of assets. So this is where we see a disproportionate reaction to a company that shouldn't really be affected that way. Now what we're seeing is a reopening of China. They've eliminated the zero COVID policies. And most of the investment banks are saying China is one of the most underappreciated assets in the world. If we go and look at NEO, at their stock price right now, And we also have the mandates for Europe to only be doing electric vehicle cars. So this is a stock that I wouldn't mind you buying at all, even though the market isn't good, because look where we are on the stock price right now. We are on the absolute base value. The market comes down and it just doesn't want to get through this price because it's too undervalued. We expect this to come up quite aggressively in the next year or two, at least 100%, probably even test the highs much higher. So if you said, Charles, I would want to buy some stocks, this is definitely one of the stocks I would be buying. So what do we need? If you bought this product today, you're going to pay a price of 66. So the dividend of 14.65 divided by 66,510 means that instead of the 14% dividend, you'll be getting a 22% dividend, and that's actually being paid monthly every month. So you would have 22% dividend income on this product, and all you need to happen is for NEO to increase by $1, well, $1.10 a share, in order for you to be generating that income. And by 2027, all you need is NEO to have increased by 10% its share value by 2027, and you would have made a capital 22% a year plus a capital gain of 34 divided by 66. You'd make a 51.5% capital gain, and all you need for that to happen is a 10% increase in NEO's share price by 2027. So that for me is probably one of the best. I'll show you just one last one that I think is a really nice opportunity as well, and then we'll stop with this because I know I'm probably getting bored of this now. Hold on a second. So this is one I love as well, ChargePoint. This is alternative energies. So with what's happening in Russia and what's happening with climate change, we see that alternative energy companies are going to do well. Again, maturity 2027, products trading at a discount, so you get a bit of a boost on the dividend and a bit of a capital gain. Currently, Bloom Energy is 46% above. This is hydrogen energy. This is solar power, and these are infrastructure for electric vehicle charging points, all the biggest in their industries. Market outlook for them is very strong, but we have a 50% protection barrier. But in this product, we have what is called a one-star feature. Even if 4 of these companies went below the barrier or even went bankrupt, as long as one of them holds its value, you will get all your money back. You'll be fully protected. So that's an extra level of protection. And this is paying out 3% every quarter. So this is really like this one and the electric vehicles one for me are 2 absolute winners that I would 100% want to have in a portfolio because of the risk return, the protection, the market, and everything that they're involved in. So just to finish off, the last 2, Paletta quantitative strategy, again, daily liquidity. This is an algorithm which looks at volatility in the stock market. And when volatility gets high enough, they jump in and trade. So let's say they're tracking the NASDAQ, suddenly volatility gets high, opens in the morning, and it's either negative or positive, they will follow the direction of that market. If it's going down, they'll bet it will continue to go down on that day. If it's going up, they'll bet it will continue to go up, because typically high volatility leads to a trend in one direction or the other. They get in the morning, they get out in the afternoon, they don't hold anything overnight. They're not buying and holding, investing. It's just about trading volatility. And the great thing about this fund is that, so this is the Paletta fund, and this is the US S&P 500 since 2016 up until 2022. You can see here, when the market is kind of not that volatile, they're not really making any money. When you start to get volatility, they start to make money. Even when the volatility starts to drop off on the downside, they can still make profits because they'll just chase that to the downside. It's not 100% accurate, but it's majority making money. So if you had the S&P 500, you'd have performed like this. If you'd have combined 50% of Paletta with the S&P 500, your performance would look a lot less volatile and be more consistent. Now, in order to express that, they have a very nice chart here. Since 2016 up until 2022, if you just had American equities, you'd have made an annualized return of 7.6%, but you'd had a volatility of 15%. For every 5% you add of Valea and take away from the S&P, you increase absolute returns and you reduce absolute volatility, which is expressed in this chart here. But you can see by having a 50% portfolio of Valea quantitative with a 50% in the stock market, you increase returns from 7.6 to 12, and you reduce volatility from 15 down to 9.6. Okay, to show you the actual performance. And this is the thing, when you want to be in this fund is when you believe there's going to be volatility. And that's the one thing I can guarantee. There's definitely going to be volatility in these markets. So let me just show you their performance. So you can see here in 2016, when they launched the strategy, they made 18%. In 2007, 11. In 2018, 30. But 2019, there wasn't much volatility in the market, so they didn't really do anything. Obviously, 2020, there was a lot of volatility, so they made 14%. But then after 2020, there was low volatility, so they didn't really do anything. And this year, there's been a lot of volatility, and they've performed. So it's a way for you to hedge out. So if we've got equities in the other products, like the structured products, and a lot of volatility is pulling them down, well, this will be making money for you. And then if the volatility goes away and they start coming back up, well, this will calm down, but then you're going to be generating all those dividend incomes anyway. You should be generating the dividend incomes 100% of the time, regardless of the volatility. But in a time of great, like if we get like a 2008 crash, then you might get under barrier with the dividend products. So it means you're still there, but you're not receiving dividend, but then other parts of the portfolio generating the income. And that's what I mean about the return is quite high for the risk profile, but it's all about the situation of the market that gives us this opportunity, which I would definitely not recommend that you buy stocks in this market, because you're taking all the risk with no income. A lot of the companies are massively overvalued. And if the fundamentals aren't there to allow growth, then why buy stocks? Because stocks are about growth. This way, we're not dependent on growth. If the market's flat or negative, we're still going to be making money. And even if one or two of the assets don't perform, we're hedged in so many different places that the overall portfolio should still be performing above 10% with this kind of strategy. And the final one that we have is carbon credits. So carbon credits are extremely important. They are being imposed heavily by governments with more and more climatic destruction and the cost of climatic destruction. The expectation for carbon credits, they're currently trading around $40 a ton. So it is a commodity. But the expectation is by Ernst & Young, if I can pull up the carbon. Ernst & Young, McKinsey, all the big names in the industry have done a lot of research on this. And it's a unanimous consensus that by 2030, the price of carbon credits will probably be trading something between $80 and $150 a ton. Also, carbon credits are a commodity. Commodities do well with inflation. And basically, the more that we pollute, the more that we have climatic change, and we already see the mandates in Europe and everywhere else, is going to pressure these companies to buy more carbon credits. And it's just a supply-demand fundamental. There's simply not enough credits to compensate the demand that's going to be there. And that's why we have this as another alternative asset. I like gold as well. I just wouldn't buy gold right now, but I would like to add gold into the portfolio. And that's probably going to be when interest rates curb off at around 5.5% in the US. We can also buy anything else. We can buy literally anything, but this is just my initial suggestion. I know it's a lot of information, but I wanted to give you a clear idea, and that's why I recorded it, so you can reflect on it. But do you have any comments at this point? Anything you like, you don't like, anything that you don't understand? I have a rule. One last thing. I have a rule. If you really don't understand something, don't invest in it.
Well, Charles, it's a lot of information that you said. The most important thing here is protection. So the investment is $120,000. We need the security that we have the same money, even though there is no earn about the investment. So protection is the most important thing here. And of course, for me, it's very difficult to decide. So I for me, it's best that you give the suggestion about the investment. So for me to decide one or another is very difficult because I am not really close to this kind of numbers. So I prefer that you are the guy, for example, that you decided. So based on the protection. So. And another thing that is important is if my mom wants to have the money 6 months later or 1 year later for do something, if you want to travel or I don't know, it's important to have the money available without any penalty. So that are the two variables that we have to consider in the investment. So.
Yeah, okay, that's very, very clear. Okay, so what I would do is I'll send you the proposal.
Okay.
I'm going to send you probably 2 different proposals. One's very conservative, the other one's a little bit more open.
Okay.
And I'll send you the video as well, so you can guess that, make any notes or any questions. And then we'll probably give you a follow-up next week, give you like 5-6 days to have a look at that, and then just come back to you and see if you like it. There's no obligation. If you decide it's not right.
Well, I have to talk with my mom, of course. She is the person who has the money. So, and well, we can talk next week and go to the next step. So.
Yeah. Okay.
The money is going to be transferred to an account of yours or of the company.
What are the next steps? Never would you send money to us. Okay, so we're just advisors, and I charge you a fee, a percentage, which is 1% a year for giving you my advice, and I only charge that fee if you achieve your goal. So if I minimum 7-8% a year, then we have to do that. Otherwise, you don't pay me. So actually, if it was 8, I'd have to achieve 9. So you can pay me 1, you still get your 8. Okay. In order to invest in the markets, you would need to have an investment platform. We can introduce you to the platforms that most of our clients work with. We take a copy of the passport and a proof of address from the person who owns the account. We do all the paperwork, but it's your account or your mother's account in her name, under her full control. You can authorize us to help you manage the account in terms of buying and selling assets, but we are not allowed by law, by governmental law, where the financial institution is, to even send an order to send money in or out. And also to protect you, the client, the only person that can send money in or out of those accounts would be you. So even if someone tried to hack your account, the maximum they could possibly do is send the money back to your bank account. So you don't have that financial risk. And that's an important thing for us, is that we keep the risk of our corporation and your assets completely separate.
Okay.
But yeah, that takes, I mean, once you give us the documentation, it takes around 10 days to 2 weeks to get the account open. The money gets transferred into the account. We start investing. And then every month to 2-3 months, we're going to have a review, how things going, what's going on in the markets, do we need to change? And anytime you need us, you say, oh, Charles, you know what, we want to take some money out. You can interact directly with the institution, or you can just ask us and we do all the admin for you. So it's completely up to you. So that's basically how.
Okay, it's clear.
Okay, and if you want to meet in person, in the old days, all my business was done face to face. So I've got no problem jumping on a plane to Mexico. I mean, I'm in Panama. I can be there within a couple of hours. So, and I always have business to do in Mexico. So if it helps you feel more comfortable to meet in person, face to face, I'd be more than happy to pay you a visit.
Okay, let me know.
I also have an office. I have an office in Mexico City where we could meet as well if you wanted to come to our office.
Okay. Let me know your schedule and the information about that, and I'm going to see my schedule too.
Fantastic. Okay, well, listen, thank you very much for your time. Do you have any other questions or doubts?
No, not really.
Okay, I'll get this all sent over to you later today, and then we'll follow you up next week.
All right, thanks, Charles.
All
Bye
right.
bye.
Thank you, Mauricio. Take care, but have a good day.
You too.